Here we go. Money Talk.
Hello and welcome to Financial Fitness Bunny Podcast, your number one stop shop to all things money management. Of course, my name is Nicolette Mashile. I am the Financial Bunny, here to put lipstick on the money pig. Before we get into today's episode, of course, we're going to talk a little bit about the book that I'm currently reading. It's called We Need to Talk About Money. It is written by Otega Uwagba. I might be pronouncing her name very, very incorrectly, and I do apologize for that. But it's an absolutely funny, candid book where she really writes about, the importance of growing up in a certain home where we don't talk about money and then having to experience all of these money issues in toxic workplaces, having dodgy landlords, jealousy about money amongst friends, and of course negotiating your pay rise in a job. But I think a lot about it, is really addressing the issues of classism, issues of privilege, racism, beauty, shame, pride, compulsion, fear, and that's all that she actually writes about. In actual fact, Elizabeth Day said that this book is a must-read, and The Times said it's a fabulous memoir. So go out there, get it. I bought it at Exclusive Books. It's an absolutely fantastic book. Now, on today's episode of Yes, Money Does Matter, we're diving into the world of loans and how the interest rate, your outstanding balance, and the loan period all play a role in determining the cost of borrowing money. How they calculate how much you will repay when you borrow money is a mathematical formula. But these numbers that we're talking about, or these factors that do come into play, are factors or numbers that you can actually negotiate so that you can ultimately reduce your cost of borrowing. But you have to understand them. So if you guys are ready, I am ready. Let's go. And let's start off with the interest rate. Well, the interest rate is a percentage of the loan amount that you are going to pay back in addition to the principal amount that you are going to be borrowing. So the principal amount is the money that you're going to borrow. So if you go to the bank and you say, I need to borrow 10,000 Rand, that becomes your principal amount. But of course, the bank has to make money. Why? Because banks, lenders are money-making companies. So they're going to charge you a certain percentage so that they can get a cost back to them for the risk that they're going to be taking, right? So if you understand this, most of the times you will go to a bank or a lender and they'll say, we'll borrow you 10,000 Rand, but we'll charge you 10%. Right? That 10% is what we call the interest rate. And basically, it is in addition to the actual principal amount of money that you are actually going to be borrowing. So if you, for instance, borrow 1,000 Rand at an interest rate of 5%, you will end up paying 1,050 Rand over the course of the loan, because the 5% is what is charged over the 1,000 Rand that you are actually borrowing, right? But now there are different types of interest rates. So if you go to a lender, they may talk about what is called a variable rate or a fixed rate. A variable rate sometimes is also called a linked rate. It's called a linked rate because it's linked to the market. So whatever decisions are made, how the market performs, that is going to be how your interest rate, your linked rate, is going to either increase or decrease. But what are we talking about when we talk about the market? So for instance, you hear about the governor, Lesetja Kganyago, and the Monetary Policy Committee making a decision in South Africa. For instance, we've seen it happen many times where they're trying to regulate or curb the inflationary rate, and what they would do is to increase our repo rate. Or in COVID-19, we saw when there was a lockdown and economies were slowing down, we saw that they decreased the interest rate, or the repo rate rather, to try and stimulate economic activity. So they made borrowing a little bit cheaper, because remember, if the repo rate is reduced, that is the borrowing from the Reserve Bank to the commercial banks. The commercial banks will also ultimately then reduce what is called their prime lending rate. And it happens in the inverse also. If the repo rate is increased, it means that the prime lending rate will also be increased. So it's very, very important to understand which one you want to get, because if you take a variable rate, it means that it will be linked to what is happening in the market. However, if you choose what is called a fixed rate, it means by the time you take out your loan, whatever the interest rate that you have been offered then, it will stay the same despite what happens in the market. So if you've been offered, for instance, 10% on a loan for 5 years, it will stay 10%. So if, for instance, let's say you took out a personal loan and you got an interest rate of 15% during, let's say maybe in 2019, took out a loan, they gave you an interest rate of 15%. During the time when, in the COVID period, when the interest rate was lowered in South Africa to try and stimulate the economy and to get more people borrowing money, and it was reduced dramatically, you would not have felt the advantage of that. You would have still had to stick to the 15%. Why? Because it's a fixed rate. When can this be an advantage for you to fix your rate? Is when you are finding yourself in a situation in an economy where the interest rate can potentially be hiked. And we saw it last year. So if you came out of, for instance, 2021, and you had taken out a loan with a fixed rate of, let's say, for instance, 9% on a car loan, right? Going into 2022, you would have seen we had a number of interest rate hikes. Those hikes would have not actually bothered you. They would have not made an impact on your rate because you would have fixed that rate. Often a lot of banks don't like to fix the rate for a very long loan period. So they may fix it for instance, a personal loan, a credit card, but they very unlikely fix it, for instance, for a 20-year home loan period. So these are some of the things that you've got to think about. But what determines the interest rate that you're going to be offered? Well, that is what we call your credit score. And what exactly is a credit score? It's a numerical representation of your credit worthiness. So I want to take you back to, and I'm maybe exposing my age here, but a couple of years ago, what schools used to do, they used to score children based on their academic performance. So they would give you a position in class. So you'd either get first position, second position, third position, depending on how many people are in the class. You would be ranked amongst your peers in your class based on your academic performance. And this would show whether, if you are on the lower side of the class, my friend, that means you're struggling academically. Of course, if you are on the higher side, it means that you are an academically astute person in the class. So almost similar to that. Your credit score is a representation of your credit worthiness. When the bank looks at you and your profile, are you somebody that they are not taking a big risk by borrowing or lending money to? Now, of course, we understand that means that lenders, credit card companies, landlords also sometimes use your credit score to determine how much risk you are if they are to lend you money, whether it is giving you credit access or they want to rent out their apartment to you. All of these things will come into play. So that's quite important. But remember, I had said in the beginning, these are numbers and factors that you can actually have an impact on your own to be able to negotiate a better rate so that the cost of borrowing is ultimately decreased. And how would you do that? It's by making sure that when you do have credit agreements, you honor those credit agreements. You pay when you are supposed to pay. You keep your credit utilization to a minimum. But we'll talk about, how do you build a credit score in a different conversation, in a different episode. Let's move on to the next factor. The second factor that is going to be looked at in terms of determining the cost of borrowing is the outstanding balance. This is simply the money that you owe on a month to month when it comes to your loan. So if you've got a banking app, for instance, you can log into your banking app and you can look at the different accounts and it will show you the outstanding balance. And what financial institutions or banks have done is that on your banking app, they won't show you that amount of money plus the interest that is potentially going to be charged. They will show you the actual outstanding balance. However, it will include the interest that was charged onto the account on a previous month. So it's very important to understand that outstanding balance that you've got is what is going to be calculated using your interest rate plus the loan period to determine what your monthly repayment is. And you can lower this monthly repayment by simply paying additional amounts of money so that you start to tackle the real amount of money that is important, and that is this outstanding balance. So it's it's something that you can manipulate if you understand how the formula works. So let's go back to you borrowing 1,000 Rand at 5% interest rate for a loan period of, let's say, two years. At the end of the first year, you would have paid 500 Rand of the principal amount, which means that you are left with an outstanding balance of 500 Rand, right? However, you also have paid 50 Rand in interest, bringing your total outstanding balance to 550. So a lot of people would think that, no, after the second year, I'll be done. But you are done, but you would have paid additional amounts of money. So over the 2 years, you would have most probably paid, the first 500 plus the 50 Rand that you were going to get charged as an interest. And then in the second year, they're going to calculate 5% over the 550 and not an outstanding 500, because remember, you borrowed 1,000 Rand. So logic says to us, mathematics says to us, if you've paid 500 in the first year, it means you've got an outstanding balance of 500. But however, because of the interest, right, it means that you still have an outstanding balance of 550. So why this is an important thing is that, one, it can help you in understanding how much extra you need to pay so that you can keep decreasing the outstanding balance, so that when they work out your monthly repayment, it becomes lower and lower. And this also helps you pay your loan faster. So it's not just about paying less, it's also about paying faster. Now, we tell people this all the time. Somebody will say, Nicolette, I need 5,000 Rand. Then I say, go to the bank. When they go to the bank, they apply for 5,000 Rand. The bank offers them 10,000. And what people do, because that's human nature, they want to take the 10,000. But don't borrow more than you need. Don't take more than you need. Because the moment you take more than you need, you must understand that the interest rate is going to be charged against that outstanding balance. And that will determine what your monthly repayment is. The last factor I want to speak about is the loan period, which is simply the length of the time that you have to pay back the loan. And it's such a contentious area because people will say, yeah, the bank will give you a loan for 5 years, but they want you to take 20 years to pay off a house. Well, guys, that's because the bank is a money-making company. At the end of the day, the longer there is an outstanding balance, the more they can actually charge you for it. So it's like having an umbrella, for instance. So you've got an umbrella, you're holding this umbrella out. For as long as you are carrying this umbrella, or for as long as it's raining, you need to have an umbrella. So the representation of the rain is the outstanding balance. Now, for them to give you an outstanding balance, they've got to elongate how long you should take to pay off this loan. So what do? They give you an umbrella and then they just make it rain for the whole year. That's basically what the banks are doing. So it's important to make sure that you also shorten the period at which you are owing the bank money. Because as long as there's an outstanding balance, you gotta pay them. It's like living in someone's house, an apartment, and you're paying rent. They're not gonna charge you rent if you move out. But as long as you're staying there, they've got to charge you rent. So it's very important to understand this. And I want to use the home loan as a very, very simple exercise of showing you how much more you end up paying if you keep the loan open or have an outstanding balance for long. If you take out a home loan of R1,000,000 at, let's say, prime, 10.5%, over 20 years, you will end up paying 2,396,000 Rand. 2,396,000 Rand. If you take out the same loan at R1,000,000 Rand with an interest rate of 10.5%, over 30 years, you end up paying 3,293,000 Rand. That is a difference of almost 900,000. That is a lot of money. It's a lot of money. In 10 years, you could have bought a second apartment. It's almost buying your apartment twice. So very, very important to understand this, because the interest rate, the outstanding balance, and the loan period, they all play a crucial role in determining the cost of borrowing money. And by understanding these factors, you can then make informed decisions about taking out loans and budgeting for your future. You've got the powers in your hands. And that is what this podcast is all about. It's about taking the power and putting it right back into your hands so that you can make informed financial decisions. Thank you very much for tuning into the Financial Fitness Bunny podcast. This was an episode of Yes, Money Does Matters. Join us next time as we delve more into the world of finances and money management. And until then, happy 2023.